Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. This video today is a continuing in my series where I tried to cover all 11 sectors. I've got 2 left. Today I'm going to cover real estate, which will be primarily REITs. And then the next video and final video I'll be covering utilities. I want to make a couple of comments about REIT. People have to realize that different investments are really appropriate for different strategies. It's not always about trying to quote-unquote beat the S&P 500. REITs specifically are great income vehicles. They generate a lot of income, and in fact, most REITs, and the REITs I'm going to show today, all beat the S&P 500 in terms of income. So REITs make a lot of sense in a portfolio, especially for retirees who are living off of their income that their portfolio produces and trying to do that without ever burning the candle at both ends. In other words, they don't want to be selling off assets to generate income to live off of. They want the portfolio to produce the income generically and internally so that they never have to sell assets but have adequate income. But they're also looking for income growth. And I'm going to say that REITs provide both of those opportunities. So let's go ahead and get into the FastGraphs Fundamentals Analyzer software tool and look at the 12 REITs that I screened for and then called out of about 30 REITs that my screen originally produced. But I've got 12 that I want to cover with you today. So let's go ahead and look at FastGraphs. So what I've done here is I've created a portfolio and I've called it income REITs. Okay, these are REITs for income. And then I created a view on that portfolio I named REITs. And here, what I've got here is credit ratings, estimated free cash flow growth, estimated free cash flow annualized rate of return, the subsidiary that they're in. And you'll see there's multiple different kinds of REITs here, but there's also one company, which I'll be going over, that's actually not a REIT. Okay, it's really more of a real estate investment. And then dividend yields, I can structure this by highest to lowest. The highest is 7.98%, and the lowest yield I've got here is 3.6%. Okay, and these are all trading at price to cash flows that are reasonable relative to what I would consider the company's intrinsic value. Now I'm going to go through these in alphabetical order for you and look at them. And this is a high-level presentation. So what I'm going to do is just establish some ideas here and talk about REITs and really talk about the nature of REITs and why you should consider them if you're looking for income. Let's say you're a retired person. But the reality is the S&P 500, as I've put it out in every one of these videos I've done, is really extremely highly valued today. Okay, and so let's go ahead and go into it. Let's go into our dashboard here on FastGraphs, and let's just look at the S&P 500. Now, this orange line is a PE ratio of 15. The blue line is a PE ratio of 20, that's the range that the S&P typically trades at. The 20 would be high value, but fair value. The 15 would be intrinsic value or opportunistic value. Okay, that's how I look at these valuation reference lines. And you can clearly see the price of the S&P 500 is clearly above even the 20 multiple. Okay, it's currently trading at a 24 multiple. That just means that it's very, very highly valued right now. So going into the actual individual REITs here, and as I mentioned, I'm going to do them in alphabetical order. Let's start now with the first REIT that I have here, which is Agree Realty. Okay, now a couple of things I want you to note as I go through these companies. Number one is this orange line is critically important. I'm going to take price off the graph because this orange line calculates a growth rate. And this is adjusted funds from operations growth, which is the best metric to look at when you're looking at REITs. And this is an analytical tool, FastGraphs. So I'm going to call out the 2008 numbers here where we even had a dividend cut, which is the white line on this graph. So I'm going to drop this to about a 16-year graph. And we see now that the REIT is approaching a 5% growth rate, 4.79%. So this orange line, this will be true of all these REITs I'm going to show you. So kind of set this as your benchmark so I don't have to repeat myself and I can move through these companies rather quickly. This is a 15 times AFFO. This is 17 times AFFO, which is the normal market value of this REIT. So now when I put weekly closing stock prices on the graph, you can really see the relevance of both these lines. Now, there were very attractive valuations for this REIT back in 2012, 2013, even in all the way through 2015. It was trading at or below the orange line. These would have all been opportunistic times to invest. And then starting in 2015, it began to separate, and then we had very high valuations, above 20 multiples in August of 2016. And then coming into COVID, we got into 23 and 24 multiples. And then we've had an adjustment back to a 15 multiple. This would have been a good opportunistic time to buy, but then the stock has rallied, and this is relevant probably to interest rates and the fact that they were cutting interest rates during this time. And that got the stock rallying. I would consider this REIT a little overvalued right now, or certainly fully valued. I would like to see it down here in this orange line, which would be closer to a $61 price, and it's currently trading at $69.52. But you can see there's been a reset of valuation and then a high valuation going forward. So looking at this REIT, I like this REIT. I would be watching to see if it would come back into fair value. If the price was dropping any or dropped any, then I'd be willing to consider this REIT. Right now, I consider it a little expensive. However, it does offer a 4.37% dividend yield. It's BBB plus rated and only has 34% debt to capital. So the only thing I don't like about this REIT, it's been a very consistent grower. I don't like the current valuation, as I consider it a little high, but it's not bad. I mean, it's within reason, especially if you're looking at the last decade or so. Okay, so that would be Agree Realty, and it's a retail REIT. And by the way, you can always go into FastGraphs, those of you who are subscribers, you can go into the company's corporate website, and then you can basically learn what they do. You can learn about their properties. You clearly see Home Depot lined up here. It gives you a map of where all their properties are, and of course, they want to get me to sign up for some things here, but you can do that on your own. But you can learn about the companies you're at by going into the external links here. So let's move on to the second out of the 12 REITs here that we're going to talk about. And that would be Alexandria Real Estate. Now I'm going to max this out again. It's very critical to utilize this functionality. Okay, and once again, you see some craziness, high valuations coming into the 08-09 recession. They even had to cut their dividend during that time. But again, if I drop this down to a 17-year time frame, we see that they've had good dividend growth each year. The dividends have gone from $1.86 a share all the way up to $5.19 a share estimated for this year, which hasn't concluded yet. It usually takes about 45 days for companies to produce their financials. But we're looking at decent dividend growth each year. Now, if I go into the performance section and scroll down to my performance here, you'll see that the dividend growth has been about 6%. Now, one thing that I mentioned very briefly, REITs will not necessarily outperform the S&P. This one did not outperform the S&P over this time frame based on total rate of return. The S&P did 11.5%. This REIT only did 2%. But I want to evaluate that a little bit. I want to look at that for you. So if I go into the company again, okay, and look at the REIT was a little overvalued and it's now undervalued. The S&P is now overvalued. Okay, so that is a factor. Measuring performance without simultaneously measuring valuation is a job half done, as I've often said. So when you look at the valuation comparison, the S&P is very highly valued. The REIT is undervalued. But I do want you to note this. They paid $6,770 in dividends per $10,000 investment versus $5,300 in the SPY. Now, their dividend growth rate was slower, but they produced more general dividend income. Now, moving into the next REIT on the list here, let's go ahead and go into the next REIT. Let's look at Camden Property Trust. And again, I've cut this down to a 17-year REIT. The normal valuation here has been about 21 times AFFO. And I want you to notice this stock has consistently traded at a premium. Now, it did get real inexpensive in October of 2023, where you could buy it at a 14 times AFFO. That, I think, would have been a great time. This is a multifamily residential REIT. It did rally back up to its more normal multiple and is slightly below that now. So this could be one that could be considered fairly valued based on the way the market has been valuing the stock, with 3.69%. But you can see the effect of high valuation. When the market got really high, I like to say when you see high values like this and you get this massive appreciation where the stock appreciated over this time frame by an annualized rate of over 42% a year, that was extraordinary performance. But this is classically when the other person appreciated this REIT a lot more than I appreciated it. That to me is the primary definition of appreciation. And then of course you saw this subsequent reaction to overvaluation where the stock dropped over 46%. I didn't hit peaks here and I didn't hit the valleys, but you can see that was a massive drop in the valuation. All right, this REIT again looks like it's reasonably valued today based on the way the market normally valued it, if you're willing to take that risk. It's never traded at the orange line. I want to make that clear. The next one on the list I want to look at is CT Real Estate. Now, once again, I'm going to shorten the time frame to get rid of an anomalous number. We have about a 4.85% growth rate. We've had periods of very high valuation, not very high, but higher than normal valuation. You can see this is about a 15 multiple real estate investment trust, at least over the last 10 years or so. It's currently only trading at an 11 multiple. And so that would give us the ability to see some really nice rates of return of over 20% a year out over the next couple of years, just based on the company reverting back to a normal multiple. We've also got a very high 6.53% dividend yield. And again, if I look at performance, and I want to put this in perspective, it was modestly overvalued at the beginning. It's now undervalued. So performance, and the S&P is overvalued. So performance during this time was very weak compared to the S&P. But dividend income was $6,330 versus $2,610 over this time frame, which started in December of 2014. All right, so the point I'm getting at is this REIT did produce significantly more income than the S&P, even though it was overvalued. All right, but if you'd have bought it during this period here, where it was only trading at a 10 multiple and it's now trading at 11 multiple, you would have made 12% a year instead of 1% a year. My point is valuation matters, and it matters a lot. So even though we've had this drop in valuation over the last couple of years on CT Real Estate Investment Trust, which again is a retail REIT, and by the way, a Canadian retail REIT. And once again, you can always go into the company's corporate website and basically learn what the company does. Canadian Tire is obviously one of their big properties. Okay, so this REIT looks reasonably valued. I'm going to move along here and be quick here because the next one I will look at is information services. Now, this is not a REIT. Okay, it's a real estate services company. It's faster growing than most. And if I cut this time frame down just a little bit here, you can see that it starts at an attractive valuation during this time frame, which started in December of 2015, and it's grown at almost 10%, 9.88% per year. When I look at performance of this business compared to the S&P, we see it closing the gap. It had a 7.48% annualized growth without dividends versus 12 in the S&P, but it ended up giving us 10% total return versus 13. But once again, it paid $5,000 in dividends versus just over $2,000 in dividends for the S&P during this time frame. Once again, it outproduced the S&P in terms of income, even though the stock is currently undervalued and the S&P is overvalued. Okay, but it's performed pretty consistently in its growth. It does look very attractive going forward. It only offers a 3% dividend yield, I might add, which is not bad. And so if you're looking at for the next couple of years, this could generate a 21% annualized rate of return, which is a function of it growing by double-digit rates, plus the PE increasing from 13.21 currently up to a 15 PE, and it delivering the earnings growth. So that's giving you a clear idea of what your rate of return could be on this particular company. Moving on, that's the only non-REIT in the group I've got here. Moving on, we've got Killam Apartment, and once again, it was reasonably valued. It was trading at high valuations much of 2020, 21. We've had this reset. It's moving into fair value. I don't think it's quite there yet. It's had decent growth. This is one, again, I think all of these 12 are stocks or real estate investment trusts you can keep your eye on. I'd like to see some of them here at better value. Mid-America apartment communities and multifamily residential. Again, the market likes to put a premium valuation on this A- rated, very high quality multifamily residential REIT. Once again, to put that in perspective, go into the company's website and you'll see what the company does and what kind of properties they actually own. And you can learn more about by perusing the website here. Hit the About button, ask what the company does, and you'll get all this information on any of these REITs that I'm looking at. I'm just showing you. I consider this REIT normally valued based on the market with a 18.96 PE, maybe slightly below normal, but again, I would like to have bought it back in here, or I'd like to have bought it during COVID, or even here when it got into more reasonable multiples. The secret of being a good investor is buying low and selling high, and that's what valuation is all about. Morguard, North American Residential REIT, is another multifamily REIT trading at a discounted 12.59 PE. And once again, you can see that if you bought it at a 12.59 price to AFFO back here, and it's currently trading at that same price to AFFO, your annualized rate of return was 5.55%, which is the 5.54 rounded here. But again, thanks to dividends, most of your return came from dividends. You'd have averaged over 9%. So this would look like a very attractive time to be buying this REIT and investing in it for the longer term future. Again, this is another Canadian REIT, and this is in Canadian dollars, by the way. And all these Canadian REITs, when they show CAD up here on fast graphs, that means it's in Canadian dollars. So for those Canadians, it's good. Now here's one of my top choices, which would be NNN, and it's again a retail REIT. I like this stock very much. I like the valuation very much. Again, it's a very consistent grower, produces a lot of income. It has a 6% dividend yield. And again, now I'm looking at performance being a little high here. Let's move this back to a 17-year rate where I've got it trading just at a 13 PE and now trading at 11 PE. So when I go into performance here, I once again see that it underperformed the S&P on growth, but it produced more than double the amount of dividend income the S&P did. And the dividend growth has not been real high because, once again, this is not a real high, fast-growing REIT. It's been only averaged about 4.75%, going all the way back here to 2010. However, you can buy it at a very attractive valuation here. So if you did buy it today, and this is on January 12th, a PE of 11.51, and it did grow out here, and the PE did expand, you'd make over 23%. And if it went to its normal PE, you would do even better. So NNN looks very attractive here to me. My second favorite pick in the real estate space, for very similar reasons, would be the Realty Income, the monthly income REIT. Once again, trading at a very attractive 12.48 valuation. If we invested in this REIT and it traded at its normal premium valuation, because the market considers this one of the highest quality REITs, as you can see, it's A- rated with moderate debt, you could make over 12% a year in an extremely high quality REIT, once again with a 6% dividend yield. Now, looking at dividend yield, historically, this is one of the higher dividend yields that you'll see on this REIT historically. And that has to do with the valuation being as low as it currently is. So that's a big plus for this REIT. Now, the next one I'm going to look at is Plaza Retail REIT. And again, it's a relatively slow grower. It is undervalued. It does offer a dividend yield of almost 8%. It's all about the income here. And this would be a safe time to buy it. When you're buying low valuation, you're buying safety. And looking at what this stock could generate over the next 2 or 3 years, it could generate a 29% rate of return. If it traded at its normal multiple, just only 13 times earnings for the last year, you'd still be looking at generating over a 20% annualized rate of return with almost an 8% dividend yield. So this particular REIT, even though it's not a fast grower, By the way, I should have focused on that. When you look at forecasting, it's expected to grow at 4.5% over the next 2 years, all right, which is not high, but because of the low valuation, that's what gives you the opportunity to make money here. I like this REIT a lot. Again, it's another Canadian REIT. Then UDR Inc. It is an interesting one because this is one that normally commands a premium valuation. So let's drop a couple of years off the graph, and we can see the market has valued this at 21 times AFFO. It's below that now, offers a 4% dividend yield. It's BBB plus, but does have 60% debt. So in other words, this one is one that is approaching fair value. It was a great value in September of 2023 and actually November of 2023 when it got down to a 15 price to AFFO. Valuation matters, and it matters a lot. But again, this has been a premium REIT from a standpoint of BBB plus. That's a very high rating for REITs, and it's been a nice steady grower and producer over time. Now, that's all the REITs that I'm going to cover in this video. However, and I know you're going to ask, okay, so let me point something out. Everyone's always asked about MPW. I'm going to do a separate video on MPW and talk about what I see as the intrinsic value and the potential of that very beaten up REIT over the next couple of years at least, to give you some reasons why. And I think you'll find that interesting. So that's going to be a bonus video attached to this. But these are the 12 REITs that I've liked and that I feel like are worth looking at. I didn't include any office REITs. There's a lot of real estate that's going through issues. These are just 12 REITs that I thought had really consistent goods, consistent growth, high quality and safety. And out of this group, there could be some that you might find interesting. If you like the video, give me a like, ring the bell so you get notified of future videos. Subscribe to the YouTube channel if you haven't already, and take a look at subscribing to FastGraphs. It's a great tool to help investors. When I do the MPW video, I'm going to get more in depth of what you can do with FastGraphs as I'm analyzing that troubled REIT. Thanks for watching. We'll talk to you again real soon. And again, I have put a link to the MPW video at the bottom of this video so that you can look at that video as a special bonus to this video. Again, thanks for watching.